On the 13th of March, India quietly changed one of the oldest rules in the stock market. From that day, the country's very largest companies could list on the exchange while selling the public a small slicer than anyone before. 98 days later, the biggest company in Indian market history walked through the exact door. The largest IPO this country has ever seen is selling you 2.9% of itself. The smallest public slice the rule now allows. And it touches you more directly than you think. You probably recharge a Jio number, maybe 250 rupees a month. That recharge done before you have ever used a single gigabyte of data is wide into part of this IPO almost no one on your feed is pricing. So today, 4 things hiding in plain sight. The rule that was rewritten. The cash machine nobody mentions. The smart money that quietly refused to sell. And the discount that may quietly cause the ordinary Reliance shareholder. None of this is a tip. All of it is the architecture. First, the scale. Stated fairly, because it is genuinely enormous. Jio platform is the telecom and digital arm of Reliance. It serves over 520 million customers. That is close to 47% of every mobile connection in India. Last financial year, it earned roughly 1.46 lakh crore rupees in the revenue, with a net profit nearly 30,000 crore. Its borrowings have fallen hard. Net leverage down to about 0.36 times. A strong, profitable, lightly indebted business. So when Reliance finally lists, the headline writes itself. India's crown jewel goes public. And the story you're being told is the story of how much it's worth. That story is true. It's just not the interesting part. There are 4 better questions underneath that story. Let's say out the bull case honestly, because it's a good one. This is 100% fresh issue. Every share is newly created. So the money raised, around 37,000 crore, flows into the company itself, not to existing owners cashing out. That cash is for debt repayment and the build out everyone is excited about. 5G, 6G, fiber and very large bet on artificial intelligence. And the engine looks healthy. Average revenue per user has climbed to about 214 rupees a month. Rising year after year as customers move to richer plans. More customers paying a little more every quarter. So the official version, a market leader, getting more profitable, raising fresh capital for the future, opening its door to the public for the first time. Very clean and compelling. Now, hold it up to the light, one number at a time. 2.9%. That's how much of itself the biggest IPO in Indian history is offering to the public. The other 97 stays exactly where it is. For most of this market life, that was not allowed. The rule pushed large companies to float a meaningfully bigger share over time. So price discovery was real and ownership genuinely spread. Then weeks before this filing, India opened a new path. Companies valued about 5 lakh crore rupees could list with as little as 2.5% in public hands. It's a general policy for all mega caps. No special favor. But the first biggest company through that door is the largest of them all. Here is the banker's question, asked plainly, with no villain in it. Why design a market so its biggest company can go public while keeping almost all of itself? Picture a Kirana owner who finally agrees to take in partner and then sells them the till drawer, not the shop. A tiny float meeting enormous demand. Fewer shares to go around means scarcity does part of the pricing for you. It also means the people who already own it keep near total control. Not an accusation, just an architecture, and the part the valuation headlines don't dwell on. That's loop 1. Now, where does the cash actually come from? Here is how Jio actually banks. The question a glassy investor deck never answers. Most of Jio's customers are prepaid. They recharge first, then consume. You hand over 250 rupees today for a month of data you have not used yet. Now multiply by over 550 million, recharging on rolling cycles, every day of the year. At any moment, Jio holds a vast pool of money it has already collected but not yet earned. Payment in advance for a service it delivers over the coming weeks. In banking terms, this is float. The same idea as a chit fund holding the members' pooled money before it paid out. Except this pool refills faster than it empties because tomorrow's recharge arrives before today's data runs out. The business is, in part, financed by its own customers paying ahead. That's the plumbing. A normal business funds the gap between paying its cost and getting paid. It borrows or it waits. A prepaid teleco at this scale can run the opposite way. The customers fund the gap. So loop 2 closes. The owners keep about 97% of a company whose day-to-day cash is supplied in advance by the very pool recharging their phones. Hold that thought because it explains the third thing that nobody is talking about. Rewind to 2020. In a single dramatic stretch, global names put in roughly $20 billion into Jio. Meta, Google, private equity firm KKR, and sovereign wealth funds from Abu Dhabi and Saudi Arabia among them. Together, those outside investors came to hold about 33% of the company. Now, the natural assumption. After 6 years, an IPO is obvious exit. Early backers sell some shares to the public, book their gains and go home. And in fact, that was the early plan. Reports said these investors would trim their stakes in the listing. Then it changed. The structure was switched to a 100% fresh issue. No existing owner selling at all. After a valuation disagreement between Reliance and those very shareholders. Sit with that. The people who's watched this business from the inside for 6 years had a chance to sell. And the deal moved to a shape where they don't. There was a gap between what the company wanted to be valued at and the price at which the early money was willing to part with shares. So the early money stayed. Here is the discipline, and it matters. This is not a signal to buy or to avoid anything. This channel doesn't do that, and the rules don't allow it. It's a fact about negotiation and the ownership. When the smartest, earliest money in the room declines to sell into the biggest IPO in the company history, that is not an instruction. It's a fact about the negotiation and the ownership. When the smartest, earliest money in the room declines to sell into biggest IPO in the company's history, that is not an instruction. It is a question worth carrying. We will put it on the list at the end. Loop 3. Open on purpose. So what does all this to do with you? Depending on which door you are standing at. If you are a small investor chasing an allotment, you are chasing deliberately scarce slice that great many people want at once. Scarcity plus demand is a powerful combination and it cuts both ways. If you already own Reliance shares, there is a quieter catch. And this is the fourth thing. Analysts have flagged a holding company discount. Strip the jargon. The market tends to value a big parent at less than the sum of its parts because the basket is complicated to price. A holding company is like a fruit basket sold for less than the fruits inside. The buyer pays for hassle of wrapping. The IPO makes one fruit's price visible. It puts a public number on Jio, but it doesn't force the basket to catch up. So value unlocked can be real on screen and still not arrive in the ordinary shareholder's account in the way headline implies. Put the four together and the shape is clear. A small slice sold through a freshly rewritten rule. A cash machine quietly funded by customers, early owners who choose not to sell, and an unlock that may stay mostly on paper for the smallest holder. None of that tells you what to do. All of this tells you what you're looking at. So if you are open the draft prospectus and you should, before forming any view, here are the questions worth carrying. Not what to buy, but what to understand. 1. Find the line of income received in advance or deferred revenues. That's the float. Money collected before the service is delivered. See how large it is and which way it moves. 2. Ask what a 2.9% float does to price discovery and to your odds of an allotment. A thin float behaves differently from a deep one. 3. Ask why the early investors moved from selling to staying and what the valuation gap behind that switch tells you about price without turning it into a prediction. 4. If you hold Reliance, ask whether the value being unlocked reaches to you or mostly re-rates on a screen because of that holding company discount. The headline everyone chases asks one question. What is Jio's worth? Obvious question. Wrong place to start. The better questions are the 4 we opened with. What is actually being sold? A remarkably small slice, made possibly by a rule rewritten weeks earlier. Who funds it? 500 million Indians paying before they consume. Who held on the earliest, best informed money in the room? And who captures the unlock? Maybe not the holder the headline is speaking to. You will do your next recharge sometime this month, before you have used a single gigabyte. Now you know which side of the cash cycle that puts you on, and how much of this story was never about the valuation at all. This is structural analysis meant for understanding, not an investment advice. I'll see you in the next video.